In the past 25 years, America's stock market has soared, driven by corporate profits. According to The Economist, the worldwide earnings of all American firms, whether listed or not, have risen 445% over this period and are now above 35% above their long-term average relative to GDP. America Inc. mints $1 billion every 5 hours. But with trade wars and corporates gearing up their balance sheets in the hopes that the good times will roll on forever, will the bull run continue to run? To find out, Edgar Mafoko, portfolio manager at FNB Wealth and Investments, still with us in studio. We are now joined, however, by Bruce Main, founder of Ivy Asset Management, and Francois, Strydom, portfolio manager at Momentum Securities. Gentlemen, welcome. I see that we are into the second week of the second quarter earnings season in the US. So far, things looking really good. The question is, are we expecting this to continue? Bruce, to begin with you.
So I think first of all, in context, which I always think is very useful, is Goldman Sachs has recently done a survey, 4,000 companies, and I think that's what you've got to watch out for. So most of the expectations of these 4,000 businesses are for earnings declines to start coming in. So I think you have to be wary that eventually the Trump-related activity is starting to hit the bottom line of businesses. So there's no doubt that earnings misses are now more likely, and we've obviously seen that with the likes of companies, for example, Netflix, which had a big miss, big drop in the stock price. So if you price for perfection and you're disappointing, your share prices are going to be hurt substantially.
Francois?
Yeah, no, I can echo that. I mean, in fact, it brings out these figures every quarter about where they see companies posting earnings guidance, and about 114 companies have posted earnings guidance. 88 of those companies have posted negative earnings guidance. So if that remains the same, that's about the worst negative earnings per share growth expectations we've seen since 2006, the second worst quarter. Seen differently, you could probably look at the average earnings per share growth consensus being negative 3%. But then again, the last 5 years on the S&P 500, 75% of the time, more or less, companies actually outperform their earnings expectations. So it's a tricky one to look at. And we think there's a couple of things we need to address and look at the red herrings before just looking at earnings per share growth in general.
Because quite a number of blue chips coming out with their numbers this week. The FANG guys, Facebook, Amazon, Alphabet, McDonald's, Boeing coming out with their numbers. But if companies are not expected to do as great as we have seen in the recent past, in the second quarter, I'm just interested, Edgar, in your take on whether you think the slowdown is going to continue until the rest of the year.
It's going to be an interesting one. We're expecting US GDP numbers to come out on Friday as well. And I think we're expecting about 1.8. So that certainly confirms that there might be a bit of a slowdown in growth. And I think you're going to start seeing that in the company earnings as well. I mean, as Francois mentioned as well, we are starting to see a lot of negative consensus numbers rather as well. But I think with the FANG names, I think that will be a bit interesting. But remember, they are not as overly exposed to the US as a lot of these other consumer or industrial companies. But I think, yeah, definitely it will be very, very interesting. And we mentioned Netflix, a big miss there as well. And I think, given that we are at the top of a cycle, a small miss in the numbers, could see a big re-rating in the stock of any company. So
because as I understand, it's 11 years now that we're into this bull run on Wall Street. I mean, is this the time when the party ends?
We were actually talking about it earlier before we came into the studio. The last time interest rates were at the levels that we are at the moment was in World War II. And now we're looking like we're heading back to where we were in 2007. So there's absolutely no doubt that if you look at where federal policy is going to go, are we going back into quantitative easing? It's certainly looking like you might be heading that way. And perhaps suitably for Trump, if you get a situation where the economy weakens now and he can put the correct stimulus that starts coming in a year and a half's time, that's perfect for his re-election campaign. So, I wouldn't put it past him to be doing that. So yes, I think what you have to be wary of is obviously where interest rates are. Look for specific businesses that are still able to navigate these type of waters. The likes of companies like Facebook, we really like. Disney as well, we think is reasonably well positioned in the content space. So look for the businesses that have got great franchises, strong balance sheets, and can obviously survive any kind of economic decline.
I mean, of course, this economic decline that we are talking about has largely been driven by concerns of slowing global growth in the wake of the trade war. So in the event that we have a trade deal in the third or fourth quarters of the year, perhaps your outlook for these US companies will change. But in the event that we don't, Francois, which companies would you be looking at?
So I think before we even look at the companies, you have to take one step back and say, how does this global trade affect the different sectors, right? And what we're seeing already is global trade already moving into the manufacturing sector, where new orders, capital expenditure plans, and hiring incentives, or at least the environment for hiring, is starting to become more and more negative. And you can see it in the material sector, and you can see it in the industrial sector. Especially those are the two sectors leading this earnings decline in the S&P 500. So at the other side of the spectrum, the consumer sector is still fairly healthy. If you go and look at real wage growth, consumption, the payroll figures, that's still a healthy sector. And in between, the services sector, where the big boys like Microsoft and the like play. So it's sort of a tug and war between the trade growth, the trade deal or global trade, and monetary stimulus or monetary reflation. And that's the knife's edge. And you need to go and pick a company that's sort of still in a healthy sector, but at the same time can take advantage of a trade deal that goes the right way. So for us, it's balancing the portfolio between healthy consumer sector, healthy the services sector, and then looking at industrials that we think there might be opportunity, like Boeing, for example.
Boeing, all right.
Yeah.
Is that as a result of the massive destruction in its share price as a result of those plane crashes, or because the external factors, as you just described, put it in a better position to withstand further storms?
Yeah, so the external factors are definitely part of it, but Boeing's got a business cycle that's much longer than the average person would think about. If you go and look at their order book, just on the 737 MAX, it's still 4,600 planes, the order book backlog, right? If you go and add the other orders, there's still probably in excess of other products they sell, excess of 6,000 units. So the cycle is longer than people expect, and it's something that if you go and look at Fitch's last credit rating report, a stable balance sheet, enough liquidity, healthy markets where they operate in terms of Asia. So that's a company that for us is still showing value. We might have reduced it a bit at the $440, and we got lucky at the exact point in time. That's not what we try and do, but it's something that we still see as value, at least in the interim, especially around the noise that's been going on. Yeah.
Edgar, just to reflect on the FANG stocks, there is a view in the market that these technology plays are not adequately pricing in the risk of tightened regulation. And I mean, just putting on the table right now what Facebook is trying to do with Libra and the resistance that it's getting there. If that goes right, so it's fantastic. But if it does face a massive resistance, then it's something else. So talk to me about the FANG sector and whether they are adequately pricing in increased regulation.
So the one thing about regulation is, it's very difficult for you to price in a number to say, look, if this happens, then you'll probably take a knock of this much. So it's not as easy as a trade war, for example, to say, look, if there are trade barriers in Europe, for example, this is how much you stand to lose in terms of sale. So saying that they haven't really priced in the regulatory uncertainty, I would say somewhat is correct. I think you've seen some of the pullbacks that we've seen whenever there is antitrust judgments that have been handed down. I think Alphabet is a good example in the last quarter. But I think going forward as well, I think it is a challenge, yes, for market to try and find or correctly rather price in these uncertainties going forward. But I would say at the moment, I think if you take Alphabet, for example, Google, they've been stable over the last few months or so. So it doesn't look like they've really run ahead of this bull market that we've seen this year, actually. So I would say, market probably fairly values the FANG stocks at the moment. But I think going forward, yes, we'll have to do a bit more work in terms of the costs around these uncertainties. But I think I would say at the moment, definitely priced in fairly, in my opinion.
Bruce, just final thoughts from you playing the US market. Given that we are expecting quite a significant slowdown in how companies can deliver, should we be putting more money in the US, or should we rather be taking that money out into sort of higher yielding emerging markets? Your thoughts?
So I think, look, remember, you can buy most multinationals that you're buying in the US, you're buying the world. I mean, these companies operate globally anyway. So I think the US market's still one of the greatest opportunities in terms of diversified businesses. China, you're starting to get some interesting talk of further relaxation in investment opportunities. So I think there've got to be some opportunities that are starting to present themselves in China. Got to do a lot more homework there. It's a little bit harder to get into the nitty-gritty of the businesses themselves. And obviously, as I said, it is a slightly more protected economy. But I think if we were to look at it and just reflecting on what Edgar said earlier on Facebook and Libra specifically, the directors played it quite cleverly in Senate by saying, if we don't engage and produce this a currency that can be moved across wallets quite easily through WhatsApp, ultimately other businesses are going to do it. So do you want it to be an American company, or obviously, and there was the play on the current China
America
war.
first.
We know very well. I mean, WeChat Pay came to the market in 2010. It's 55% of the payment market in China. That went from a $1 trillion market to a $17.5 trillion market in 9 years. So it gives you an idea of owning the network, being able to get access to the people. That Facebook's already done that. So there's no doubt if they can get that currency right, it really could be a potential huge profitable center for Facebook going forward. So that certainly for me is an interesting company on where it is now and where all of this legislation goes.
All right, gentlemen, thanks so much for your time. We will leave it there. Thank you to my guests, Edgar Mafoko, Portfolio Manager at FNB Wealth and Investments, Bruce Main, founder of Ivy Asset Management, and Francois Strydom, Portfolio Manager at Momentum Securities. That is where we leave it for today's show. Thank you so much for watching. Remember to email your questions to portfoliowatch@abn360.com and your tweets to #PortfolioWatch. Until next time, it's bye for now.